Hi everyone and welcome to the chapter number 14, that is accounting for the financial instrument. In this chapter, the objective of our chapter is to understand what is the financial instrument, understand what is the difference between different financial instruments, like what is the debt instrument and what is the equity instrument. And if we have a debt or equity instrument, how are we going to measure it? So what will be the measuring rules for this financial instruments? In this chapter, we will try to cover three accounting standards. Number one is a financial instrument, that is IASB 7. Basically, it's about its disclosure. Second is about the presentation of this financial instrument and how we're going to present that in our financial statement. Like if there is a debt financial instrument or the equity financial instrument, on which part it will be shown, how we're going to record that, and how we're going to subsequently measure it. And in the end, there is IASB 9, which will be the part second of this video, that is about the financial instrument, especially it leads to the derivatives. So number one is, what is the financial instrument? Financial instrument is basically a contract between two parties, where one party has to give an asset in exchange for another party liability or equity. So if there is an increase of you can say $10 for one asset of a company A, it will definitely impact the same $10 on the liability of the equity of company B. So that's a overall definition given by IASB 132 for the financial instrument. Moving further, what is the financial assets? So financial assets, there are several types which you have studied out so far. So there is a primary financial assets and there is a secondary financial assets. We'll discuss that later on. So primary one, like you have a receivables, you have a cash at bank in your financial statement. Then a little bit advanced is a trade receivable or a right to have received cash, any potential or favorable contract which will in future give you a benefit, and you can get some money from the party B, or you can get some liability from the party B, or you can have a right in the equity of the party B. So that is all comes under the financial instrument definition. So in this one, we will discuss about what is a financial assets. So all these types fall under financial assets. Now we talk about the financial liability. It's just a mirroring side, just the opposite for what we have studied so far in financial assets. So financial liabilities, of course, is obligation. It's an unfavorable outcome where we need to pay the party with our equity or with our liability. Or maybe we have to exchange some of our assets from our end. So we maybe pay them in trade rather than in cash, and we offer them some of the shares we have. That is a pretty much definition for the financial liability. The third one is equity. So we have financial asset, financial liability, and equity. These are the three main components of the financial assets. So equity is basically the evidence that that's a residual interest in the assets. So it's total interest, total assets less liability will be the financial equity for the instrument way, and it's also defined by IASB 132. Moving further, when we say these are contractual obligation or contractual assets, so what that means? It means if there is no contractual obligation to deliver a cash or other assets or exchange any other instrument under the condition that are potentially unfavorable, it is considered to be an equity instrument. So another definition for the equity instrument is that when we do not pay with our liability, we pay with our equity instrument. So that's a little bit another way to go around the definition by IASB 132, and they say equity is, yeah, you have to pay via equity rather than if you have an unfavorable condition where you need to pay, and you have to pay via equity rather than paying via your assets. So what's the difference between the equity and the debt? You can go through this slide. It's nice. The summary is that, like, if you have a debt, definitely on that you have to pay the interest, which will eventually affect your profit. But if you have an equity component of the financial instrument, it's kind of a nice because it's not impacting the profit immediately. However, once the profit has been declared, then we have to give the dividend on that profit, which will eventually affect your overall profit, because a dividend is a part of the profit which we give to the shareholders. So this is two different components of financial statement. One is debt, one is equity. Debt is affecting profit, equity is not affecting profit. And this is a summary of this slide. What are the different examples of financial instrument? A few of those we already discussed: receivable, payable, cash at bank, cash, bank overdraft, investment, option, future contracts, forward contract, currency swap. So some of these derivatives like option, future contract, and forward we will discuss in the next class or next video. Here is mostly about the primary instrument or the equity or debt instrument, where how we're going to deal with that, how we're going to record this basic primary financial instruments. So financial instrument is defined into two categories. One is categorization is primary, and another is the derivatives. Derivatives will be the part of the next video, as I discussed earlier. Primary is the one which is receivable, payable, cash, which you already have done, like ordinary shares. There is nothing new in the primary financial instrument. They are pretty straightforward. The moment you payable or receivable to something, you have to record that into your financial statement. Mostly the primary recording will be depending on the model adopted by the business. Whatever the model will be, they will record it accordingly. Derivatives, on the other end, is kind of a tricky in terms of recording. Like that depends on what type of contract you have. When we talk about the future option, forward contract, or the rate of interest, or foreign currency exchange. So we have to see the type of the contract which we maintain with our other party, and according to that, we will record that in our financial statement. Now, next is a measurement of the financial instrument. How are we going to measure it? So, for the measurement of a financial instrument, there are three models they discuss. What is the amortization model? Amortization model is quite same like what we have done so far in the lease. When we prepare a lease schedule, that was our amortization model. Then we can record this financial instrument fair value through the other comprehensive income, or fair value through the profit and loss. So, for example, some of the expenses that happen while acquiring this financial instrument, how are we going to record that one? Overall, what are the different types of financial instrument we have, whether it is a financial asset, financial liability, or equity, whatever these one, we have to discuss which model we need to adopt for each of this one, or what is normally or commonly adopted by each of this model of this financial instrument. And under each of this category, what are the different examples? So there are 2-3 examples which will elaborate all these three models. When we buy an equity like shares, or when we have debt, bonds, or liabilities, or when we have financial assets. So all these categories are being discussed one by one. So number one is what IASB 9 say. It says that you have to have amortization cost. That is normally you will get from the financial assets. So whenever you have a financial assets, you will get a cost model, and that cost model will tell us how we're going to record the financial instrument. In this case, is the financial asset. They say in order to have amortization cost, there needs to be fulfilled 2 criteria. Number one criteria, that the company hold that asset rather than they use this asset for trade. Second is the contract term will be a fixed. So after a regular period of time, they get a fixed amount of payment, which will be recorded in the financial assets category. So given the nature of this amortization cost is available for the debt instrument rather than the equity instrument, So let's do one example which will explain more about this amortization cost. There's a company who acquires some of the bonds, which is under the, as we know that all the financial instruments should be valued at fair value. So there's a company who acquires another company bonds, and the bond has cost of $1.066 million. Their face value is 1 million. So in this case, the 1 million is quite irrelevant because we are more focusing on the fair market value. So as I say earlier, whether it is a financial asset, financial equity, or debt, or it's a equity part, whatever the part it is, the first thing we need to do, we need to record them on the financial values or fair market value. So FMV is important. So in this case, 1.660 is the fair market value on which we're going to record them. Then they are saying they are making an annual payment from 100,000 per annum, which is the 10% of that. Whereas the fair market value of this, the fair market rate for this is 8%. So the question arises, in order to calculate the interest, should we take the 10% or should we take the 8%? We will take the 8% because 8% is the fair market value of those bonds which they have get from company A to company B. The bond would be repayable payment of 1 million in 30 June 2022. So they start the contract in 2018. After 4 years, they're going to pay 1 million. But for a time being, the cost of the share is 1.66 million. And this part is the most important. Company operates under a business model where the government bonds are held in order to collect the collateral cash flow, and there is no intention to trade them. So there is no trading, no selling and buying. So if you sell and buy, so it means it is no more amortization model. So here in this case, it is giving all the fulfill the condition for amortization model, and we will apply that amortization model and see what will happen. So there is no other direct cost in acquiring this bond. Requirement number 1. You need to prepare you need to tell why the company is paying $1.066 million for the bond. Apart from the interest, they expected to receive 1 million after 4 years. So why they need to pay 1.066 as an investment? And after 4 years, they are just getting back 1 million. Why they need to pay this one? Of course, it's not the payment they are making now as an investment. I think is the installment they're going to get 100,000. That matters. So 400,000 will be piled up in the 4-year time. Second is whether the company measure the government bond at amortization model. That yes, we already discussed that it fulfill all those 2 conditions by amortization model, and they will use this one. Calculate the amortization model, which is quite similar like a lease model for all 4 years, and provide the general entry. So these part C and part D is quite interlinked with each other. Moving further, so first we see that we need to calculate any financial instrument based on the FMV, fair market value, the moment we recognize. So financial instruments, all of them should be on fair market value, regardless whether they are the financial assets, liability, equity, debt, or whatever. So we are paying 100,000 for the 4 year. We are receiving 100,000 for the 4 year. The annuity rate is 3.312. So this is what they taken from the lease schedule. So total, it will become 331,213. That is the present value of all 4 installment per year. So this is the annuity factor. Another is the present value factor. So we calculate the present value of this 1 million, which we are going to pay after 4-year time. And we'll see after discounting that 1 million, it becomes 735,029. So total, the fair value of this time is 1.066. So this is one of the example. Second is you need to work out some of the example, determine the amortization cost of the financial assets. Now, why you think this is an amortization model? 2 of the conditions, they re-mention it, why we are using amortization wallet in this question. First of all, these bonds are not for the trade. Second, there's a fixed cash flow which is coming every year. So they are like with a combination of principal and interest. So they are kind of fulfilling all the conditions. Then we prepared the lease schedule or the amortization model. So we know the fair value of this is 1.066. The rate of interest is 8%. Every year we are paying 100,000. I think in this table there should be one more column of 100,000. So 100,000 less 855. Remaining is the principal amount, that is 14,701. So the closing present value, which is been reduced after making the first payment, is 1051541. And this is how we prepare the whole lease schedule each year. I think you already mastered while doing the lease question. So this is the same lease schedule which we are calling here is the amortization model. Now, the journal entries, which will be a little bit more interesting or trickier, because here in this question, we need to see if we are using the amortization model, the first value is measured at fair market value. For the subsequent measurement, what we need to do, how are we going to determine the initial expenses incurred? How are we going to treat that one? So first of all, we have our investment. We pay an investment of 1.066 million. That is investment to our cash. Then after 1 year, on 30th June 2019, we pay for the 14,701, which is a principal repayment. So we make a principal repayment, which is called investment in the corporate bonds, 14,701. Remaining is the interest expenses, 85,299, which is the first interest expense. Then the total payment was 100,000. So 100,000 was this, and the principal payment is this. The interest paid will be charged. This interest income that we will receive is 85. So revenue is written as a credit. Investment in the corporate bond is written in a credit form. Then next year we will do the same entry but with a different amount. So this entry system is quite similar like a lease schedule. So there is no such a difference so far. Now we discussed what is the fair market value or fair value through the profit loss when the instrument is an equity instrument. Can we do profit or loss, or can we do other comprehensive income? So again, at the start, whatever the model we use, we record all the entries on the fair market value, and afterwards we will expense out if we are using the fair profit loss account, using the fair market value through profit loss account model, or we will charge it to other comprehensive income if we are using this model. So we do one question from each model, so it will give you a more comprehensive picture. So there is a company who acquired 100,000 shares from another company at the rate of 10. They are brokerage fees of 1,500. So brokerage fees, in case of our initial model, with the model is, since this is an equity investment, they are buying the shares. So we have to see if they are paying going through the profit loss model. So this brokerage fees, that is 1,500, will be expensed out in profit loss account. The closing market price of the company is on 30th June of the entity is 12. The company has not made an election to account for its equity investment at fair market value through OIC, that is other comprehensive income. So since this is an equity investment has two options only. One option is profit loss, and another is OCI is the comprehensive income. So when we are charging them the expenses, either we have to use this model or this model. So one of the model are option. So in this question, they clearly write the company is not using OCI model. So it means they are using profit loss account model. So how are we going to record the profit loss account model when the company has a equity investment and they have to pay for the brokerage fees? Since they pay for the brokerage fees, so this broker fee will definitely expense out in profit loss account. Let me show you the entry system. So company do an investment of 1 million. They kind of pay a cash of 1.001 million, and 1,500 is the brokerage expense, and this expense will eventually goes to profit loss account. Furthermore, after 1 year, when there's a movement in the investment, when this $10 become $12 each, and there was a movement of a $2, so there is an increase in our investment in terms of a gain. So that increase is also recorded as investment in the island. That is 200,000, and the gain will be again recorded in the profit loss for 200,000. So as you can see, this was a person in which they have an equity investment. An equity investment has two options only. One is I will provide you a chart by the end of on this slide, so you can have a comprehensive picture of which model has to use what different types of sources. So here they use the equity model. In the equity model, they use through profit loss account. Now the last one is through OIC. So when we have a profit loss account, any expense which is incurred to acquire this financial instrument will be charged or expense out of profit loss account. All the profit will be charged to profit loss account rather than other comprehensive income. So these are the few things which has been changed. If this is other comprehensive income, so this will become a part of the investment. Any initial cost that has been incurred to acquire the asset, like in this case, is a brokerage fees. So now they talk about what is the difference between the debt instrument and the equity instrument. You can buy either debt or equity as you prefer, but gain or loss will not maybe go to profit loss account. Because in this case, when they have an investment, for example, we take the same example, what we have done so far on 14.6, and we consider that they have a fair value through the other comprehensive income. So in this way, how we're going to solve this the same question? In this way, we will take away the brokerage costs in the part of the investment, and we'll debit the investment with the cash. And in future, whenever there is a movement in the equity, like there is an increase, since this is a share price, that means it has been a equity rather than the debt. So, and movement in the equity, that is a two ringgit increase, a $2 increase in the equity price. From 10 to 12, there is a $2 increase and 100,000 shares. So we will charge this to debit to the investment in the company, and we will credit that in the other comprehensive income. So you can see we will use other comprehensive income rather than we are charging to the profit loss account. So because in this question they clearly mentioned that they are changing the model. They are electing from a profit loss fair value to profit loss to fair value to OCI. So that's why we changed our accounting entry as well. Now, there's a different recognition, measurement of the financial liabilities. We haven't discussed about the liabilities. It's initially measured at the fair value, just like any other financial instrument. Most liability, when they are being period of the initial recognition, we will measure it amortization cost model. We have already done the cost model, but in this question, upcoming question, we will show you again how the cost model are done. So mostly we select the cost model for the financial liability. However, some of the financial liability should be measured at the fair value through the profit loss account. Few of those, not all of those. For example, some of the derivatives. So derivatives is again in the part of next chapter, we will talk about the future and forward contracts and how they are being treated through the profit loss model rather than the amortization model, especially when they are the liability. So this is I think the last example for today's class. There's a company who has a 4-year bond. So it's kind of a bond liability with a total face value of 100,000 with a coupon interest rate of 10%. Annually needs to be paid every year. So they are paying like 10% of 100,000, that is 10,000 every year. The market value for this is 12%. So we have our interest rate, and we know we need to write down our interest rate. So the company has a discount issue price for the fair value is 93,923. So this is a fair market value rather than 100,000. So we all of know initially we have to recognize this on a fair market value rather than the face value or the book value of those shares. So amortization schedule is given in front of you, which is again quite similar like that schedule, but there is a little bit difference in this payment schedule. Here we're supposed to pay a bond at the beginning, which is 93,929. Every year we are paying 10,000 only at the rate of 10% interest, whereas the rate of interest, market rate of interest is 12%. So we have to pay an additional interest, which we are not paying every year. That is 1,272. So instead of reducing the value, it is increasing the value so far. So our loan, which was payable bond, which was 93,923 plus 1,272 will become 95,195. And next year, the interest is being charged on that increased amount. So every year it keep on increasing. After 4 years, it become 100,000. You can read the schedule. This is how the schedule has been made. Here, our interest payment is less than what we're supposed to pay. So that's considering as a contractual liability on us, which is a financial instrument practice. And every year it keep on increasing. So the question requirement is that how we're going to write the bond liability. So the moment we receive this bond as a financial liability, so first thing we get a cash with a bond payable. And again, we record them on the fair market value rather than on the face value of that bond, because this is the nature of the financial liabilities or any financial instrument that we have to write that on the fair market value. After 1 year, we make a payment of 10,000. Out of that is which is payable is 1,272. Our total interest expense is 11,727. All these three figures, if we go back, we have this figure number 1, 2, and figure number 3. So all these three figures are already given. So we just put it here in this journal entries. In the last is a picture of a summary what we have done so far. So financial instrument is of 3 types: financial asset, liability, equity. Definition of each 3 are given in this diagram. All of them are initially recognized as a fair value. Subsequently, we use different models for recognizing it. Like financial assets are normally have amortization model, fair value through PL, fair value through OCI. Whereas the financial liability is on amortization model and fair value through PL. And number 3 is the equity, which is normally or usually written on fair market value through profit loss, or sometimes it is written on fair market value through OCI. So we have done all these 3 models. We have done few of the examples. We try to understand what is a financial instrument, what is the definition, how liability is different than asset or equity, and what are the different business model that has been used. The business model is actually defined that how we're going to record these 3 instruments. So that's pretty much it from today's class. I hope to see you in the next class. Until then, take care. Bye-bye.